welcome to the deep dive. This time, you've given us quite a stack of reading material on investment strategies. Looks like we're digging deep into classic wisdom and modern twists.
Indeed. We've got excerpts from the legendary Security Analysis by Benjamin Graham and David Dodd, along with insightful commentary from financial experts like Warren Buffett and Seth Klarman and more. It's like a time capsule of investment wisdom, but surprisingly relevant to today's market complexities.
Okay, let's unpack this. What exactly are you hoping to glean from these sources? Are you building a portfolio from scratch, brushing up on timeless principles, or maybe something even more specific? Gotcha. So it's about refining your investment strategy by integrating both classic wisdom and modern adaptations. Well, buckle up. We're going to time travel through the evolution of investment thinking, spotting the gems that still hold true, and highlighting the parts that make you go, that's different now.
Security Analysis was first published in 1934. Picture the Great Depression, a shattered market. Graham and Dodd aim to create a roadmap for investors to navigate uncertainty and avoid pitfalls.
But here's the thing. Their core principles, like margin of safety and focusing on a company's intrinsic value rather than market hype, are surprisingly timeless.
Exactly. But the context has changed dramatically. Back then, information was scarce. Now we're drowning in it.
Plus, industries Graham and Dodd couldn't have imagined exist now. Tech, biotech, you name it.
Let's start with their bedrock. Distinguishing between investing and speculating. This is key EY, even today.
Ooh, yes. They were adamant about buying a business, not just a ticker symbol, right? They even warned about the dangers of trading too frequently and trying to time the market.
Spot on. And they emphasized working upward from definite minimum standards when selecting bonds, focusing on solvency and strong companies. This resonates strongly with modern value investors.
Now, where things get really interesting is seeing where Graham and Dodd's advice might need tweaking for you today. For example, they were skeptical of high-yield bonds.
True, but today's sophisticated investors have tools and strategies to manage that risk, especially with proper diversification.
And remember their emphasis on dividend payments. Nowadays, share buybacks are often favored.
Precisely. And think about the rise of index funds and ETFs. Those were unthinkable in Graham and Dodd's era.
Given your interest in refining your investment strategy by integrating both classic wisdom and modern adaptations, let's highlight some particularly insightful points from the material. For instance, their analysis of Studebaker preferred stock in the 1930s.
Ah, yes. The Studebaker case highlights how even seemingly strong companies can make decisions that erode shareholder value. It's a classic example of the importance of thorough due diligence and understanding the potential risks associated with even seemingly stable companies.
It's a reminder that no investment is completely risk-free and that even well-established companies can falter.
Precisely. It underscores the importance of analyzing a company's management, its capital allocation decisions, and its overall business strategy to assess its long-term viability.
And then there's their discussion of real estate bonds. It's fascinating how those were considered almost foolproof back then.
Right. Back then, real estate bonds were seen as incredibly safe investments due to the perception of steadily rising property values. But the 1931 real estate market crash exposed the risks inherent in concentrated investments, even in seemingly safe assets like real estate.
It's a stark reminder that market conditions can change rapidly and that diversification is crucial for managing risk.
Absolutely. Even assets that appear safe can experience significant declines in value, and spreading your investments across different asset classes can help mitigate those risks.
So it's clear that while Graham and Dodd's principles are timeless, we need to adapt our thinking to the nuances of today's market. It's about understanding both the enduring wisdom and the necessary adaptations for navigating the complexities of modern investing.
Precisely. It's about integrating their timeless insights with a modern perspective.
Now, of course, we can't talk about Graham and Dodd without mentioning their most famous student, Warren Buffett. His foreword in Security Analysis provides a fascinating glimpse into how their teachings shaped his own investment philosophy.
It's a testament to the power of their ideas. Buffett credits Graham and Dodd with laying the foundation for his success. He still stresses the importance of margin of safety, buying undervalued assets, and ignoring the noise of the market.
Love that. That timeless wisdom applied consistently can lead to extraordinary results.
Exactly. Buffett's enduring success is a testament to the enduring relevance of Graham and Dodd's principles.
But it's not just about blindly following their rules. It's about understanding the underlying principles, adapting them to the current market environment, and developing your own investment philosophy.
Precisely. It's about taking their wisdom as a starting point and building upon it with your own knowledge, experience, and judgment.
Now let's transition to another example of applying classic wisdom in a modern context. Seth Klarman's investment in Tikako bonds during its bankruptcy proceedings in the 1980s. This case highlights the potential for finding value in unexpected places.
What's fascinating about Klarman's approach is his ability to see value where others saw only risk. By delving deep into the complexities of Texaco's situation, he recognized that the company was not inherently insolvent and that its bonds were mispriced by the market due to fear and uncertainty.
It's a great example of how deep research, independent thinking, and a contrarian mindset can lead to rewarding opportunities.
Absolutely. Klarman's success in this case showcases the importance of looking beyond the headlines, understanding the nuances of a situation, and being willing to take calculated risks when the odds are in your favor.
Now, shifting gears a bit, let's delve into a concept that's fundamental to understanding a company's financial position, its capitalization structure.
Capitalization structure refers to how a company finances its operations and growth through a mix of debt and equity. It's a key element of financial analysis that helps us understand a company's financial risk and its flexibility.
Right. A company with a high proportion of debt, reflected in a high debt-to-equity ratio, might be more vulnerable to economic downturns or interest rate hikes as it faces higher interest payments and principal repayments. On the other hand, a company with a lower proportion of debt and more equity might have greater financial flexibility and resilience.
Exactly. Analyzing a company's capitalization structure involves examining its debt levels, its debt maturity profile, its interest coverage ratios, and its overall leverage. It's about understanding how the company is using debt and equity to finance its operations and assessing the potential risks associated with its financing choices.
Now, another point that caught my eye in the material was the discussion of non-cumulative preferred stock. It's a good reminder that not all preferred stock is created equal, isn't it?
It is. Preferred stock generally offers investors priority over common stockholders when it comes to receiving dividends and assets in case of liquidation. However, non-cumulative preferred stock carries a distinct risk. If a company decides to skip dividend payments in a particular year, holders of non-cumulative preferred stock miss out on those payments permanently.
So even though preferred stock might sound safer than common stock, it's crucial to examine the specific terms and conditions to fully understand the potential risks and rewards.
Absolutely. It highlights the importance of carefully reading the fine print and understanding the nuances of different types of securities before investing.
Now, speaking of understanding nuances, let's talk about the changing landscape of information available to investors today. We're drowning in data compared to Graham and Dodd's time, wouldn't you say?
It's a dramatic shift. In the 1930s, information was scarce, and investors had to rely on limited sources to gather insights about companies. Today, we have access to a wealth of data, including detailed financial statements, company filings, analyst reports, news articles, social media feeds, and more.
It's both a blessing and a curse. We have more information than ever before, but it's also more challenging to filter and interpret it effectively.
Precisely. It's more important than ever to develop critical thinking skills,
Yeah.
to be wary of information overload, and to focus on the key factors that drive a company's value.
Right. It's about separating the signal from the noise and focusing on the information that truly matters.
Exactly. It's about being discerning, skeptical, and selective in your information consumption.
Now let's step back into the historical context for a moment and discuss a concept that's mentioned in the book, guaranteed securities.
Guaranteed securities are debt or equity instruments backed by a guarantee from a third party, typically a parent company or a financially strong entity. This guarantee adds a layer of security for investors as the guarantor promises to make payments if the issuer defaults.
So it's like having an insurance policy on your investment, right?
In a way, yes. However, it's essential to remember that the value of a guarantee depends on the financial strength of the guarantor. If the guarantor experiences financial difficulties, the guarantee might not be worth much.
Right. So even with a guarantee, you can't completely uh, eliminate risk.
Exactly. There's always some level of risk in investing, but understanding these different types of securities and their associated risks can help you make more informed decisions.
Now let's shift our focus to a concept that's central to evaluating a company's financial performance, its cash flow. The material highlights the importance of analyzing a company's free cash flow.
Free cash flow represents the cash a company generates from its operations after deducting capital expenditures. It's the cash that's available for things like paying dividends, reducing debt, buying back shares, or making acquisitions.
So it's a measure of the company's financial flexibility
Yeah.
and its ability to reward investors or reinvest in its growth.
Exactly. Analyzing a company's free cash flow can provide insights into its financial health, its profitability, and its ability to generate value for shareholders.
Now let's move on to another intriguing concept from the book, the idea of a stock selling persistently below its liquidating value. Can you explain that for our listener?
This situation arises when a company's stock price consistently trades below the estimated value of its assets if it were to be liquidated. Essentially, the market is valuing the company as if it were going out of business, even though it might be a profitable and viable enterprise.
So it's like the market is saying the company is worth more dead than alive.
That's a great way to put it. This scenario can present opportunities for value investors who believe the market is mispricing the stock. However, it's crucial to understand why the market is undervaluing the company.
Right. There might be underlying issues that justify the low price. It could be that the company is facing operational challenges, industry headwinds, or concerns about its management team.
Exactly. It's essential to dig deep and understand the reasons behind the market's skepticism before jumping in.
Now, the book also delves into the impact of intangible assets on a company's valuation. Can you remind our listener what those are and why they're important to consider?
Intangible assets are non-physical assets such as brand recognition, patents, trademarks, and goodwill. While they don't have a physical form, they can be significant drivers of a company's value.
Right. Think about companies like Apple or Coca-Cola. Their brand recognition alone is worth billions of dollars.
Exactly. Intangible assets can give a company a competitive advantage and enable it to command premium prices for its products or services.
So when analyzing a company, it's important to look beyond just the tangible assets on the balance sheet and consider the value of these less tangible but often equally important assets.
Absolutely. Valuing intangible assets can be challenging, but it's crucial for understanding a company's true worth.
Now let's move on to a topic that highlights the importance of understanding the relationship between a company and its shareholders, the concept of stockholder management relationships.
This refers to the dynamics between a company's management team and its shareholders.
Hmm.
Ideally, management should act in the best interests of shareholders, maximizing their long-term value. However, sometimes conflicts of interest can arise.
For example, management might prioritize short-term profits over long-term growth, or they might engage in activities that benefit themselves at the expense of shareholders.
Exactly. It's important for shareholders to be vigilant, to hold management accountable for their decisions, and to advocate for policies that align with their interests.
Now let's delve into a concept that can provide insights into how a company manages its assets and reports its earnings, analyzing its depreciation policies.
Depreciation is the accounting process of allocating the cost of a tangible asset over its useful life. Analyzing a company's depreciation policies can reveal how it accounts for the decline in value of its assets over time and how that impacts its reported earnings.
So it's about understanding the assumptions and judgments that go into those numbers and how they might affect the company's profitability.
Precisely. Different depreciation methods can lead to different earnings figures, and it's important to understand how a company's chosen method might be influencing its reported profits.
Now, the text also talks about the concept of overcapitalization.
Mhm.
Can you explain what that means and why it's a red flag for investors?
Overcapitalization occurs when a company has more capital than it needs to operate efficiently. This can happen if a company issues too much debt or equity, makes unprofitable acquisitions, or simply fails to invest its capital effectively.
So it's like a company carrying excess baggage that weighs down its performance.
That's a great way to put it. Overcapitalization can lead to lower returns on investment, reduced financial flexibility, and increased financial risk. It can also signal that management is not effectively allocating capital and creating shareholder value.
Mhm. Now, let's shift our focus to a measure of a company's short-term financial health, its working capital.
Working capital is the difference between a company's current assets and its current liabilities. It represents the funds a company has available to meet its short-term obligations and to finance its day-to-day operations.
So it's about looking for signs of financial stability in the company's ability to manage its cash flow effectively.
Exactly. A company with strong working capital is generally in a better position to weather economic storms, to invest in growth opportunities, and to meet its financial obligations.
Now, let's discuss a concept that can be particularly relevant when analyzing large, complex companies, corporate pyramiding.
Corporate pyramiding is a structure where a controlling company owns majority stakes in several other companies, which in turn own majority stakes in yet more companies, creating a pyramid-like ownership structure.
So it's about understanding the layers of ownership and control within a group of companies.
Precisely. While corporate pyramiding can amplify control with relatively little capital, it can also create risks for investors.
For example, if a company at the bottom of the pyramid experiences financial distress, it can ripple upward, impacting the entire structure.
Yeah.
It also raises concerns about transparency and accountability.
Absolutely. Investors need to be aware of these complex structures and the potential risks they can pose.
Now, let's move on to a concept that's designed to protect the interests of lenders and bondholders' protective covenants.
Protective covenants are clauses included in bond indentures or loan agreements that impose restrictions on the borrower's actions. These restrictions aim to safeguard the lender's investment and reduce the risk of default.
So it's like having safeguards in place to ensure that the borrower behaves responsibly and protects the interests of the lenders.
Exactly. Protective covenants can include restrictions on the amount of debt a company can take on, requirements to maintain certain financial ratios, limitations on dividend payments, or prohibitions on asset sales.
Now, let's turn our attention to a category of securities that can be highly speculative, but also potentially rewarding low-price securities, often referred to as penny stocks.
Low-price securities are stocks that trade at very low prices, typically below $5 per share. While they can be enticing due to their low price and the perception of potential for high returns, they also come with significant risks.
Right. They often represent companies with small market capitalizations, limited financial resources, and uncertain prospects.
Exactly. Investing in low-price securities requires careful research, a disciplined approach, and a willingness to tolerate a higher level of risk.
Now, let's shift our focus to a topic that's particularly relevant to investors seeking income, analyzing companies' dividend policies.
A company's dividend policies reflect its approach to distributing profits to shareholders. Analyzing these policies can provide insights into the company's financial health, its growth prospects, and its management's priorities.
So it's about looking for consistency in dividend payments, which can signal financial stability and a commitment to returning value to shareholders.
Exactly. Investors often favor companies with a history of steady or increasing dividend payments, as it suggests a healthy financial position and a shareholder-friendly approach.
However, it's worth noting that companies in different industries and at different stages of growth might have varying dividend policies.
That's true. Some companies might prioritize reinvesting their earnings for growth, while others might focus on returning capital to shareholders through dividends. It's crucial to consider a company's specific circumstances, its industry dynamics, and its growth strategy when evaluating its dividend practices.
Now, let's delve into a concept that's particularly relevant in today's market, where stock options are a common form of compensation for employees, the impact of stock options on a company's earnings and valuation.
Stock options give employees the right to buy a company's stock at a predetermined price, typically over a specific period of time. They are a form of incentive compensation that aligns employee interests with those of shareholders.
Mhm.
However, stock options can also have a dilutive effect on earnings.
Meaning that they can reduce the earnings per share for existing shareholders?
That's right. When employees exercise their stock options, new shares are issued, which increases the total number of shares outstanding. This can dilute the earnings per share for existing shareholders.
So it's essential to factor in the potential impact of stock options when analyzing a company's earnings and valuation.
Absolutely. Stock options are a complex topic, but understanding their potential dilutive effect can help investors make more informed decisions.
Now let's talk about a type of investment vehicle that provides investors with a way to diversify their portfolios, investment trusts.
Investment trusts are companies that pool money from multiple investors to invest in a diversified portfolio of assets, such as stocks, bonds, real estate, or other investments. They offer investors a way to access a professionally managed portfolio with a relatively small amount of capital.
So it's like having a team of experts managing your money for you.
That's a good analogy. Investment trusts can be a convenient way to diversify your investments and to benefit from professional portfolio management. However, they do come with their own set of fees and expenses, which can eat into your returns.
Right. It's important to consider those costs when evaluating investment trusts and to compare them to other investment options.
Absolutely. Fees and expenses can have a significant impact on long-term investment performance, so it's crucial to understand what you're paying for and to ensure you're getting value for your money.
Now, let's shift gears a bit and delve into a core aspect of financial analysis, analyzing a company's balance sheet.
The balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. It's one of the three primary financial statements that companies are required to publish, along with the income statement and the cash flow statement.
So it's like a financial photograph that captures what the company owns, what it owes, and the ownership structure.
That's a good way to put it. By analyzing the balance sheet, investors can assess a company's financial health, its liquidity, and its overall financial risk. They can gain insights into the company's capital structure, its asset base, its debt levels, and its overall financial stability.
Now, another crucial aspect of investment analysis is assessing the quality of a company's leadership. The text emphasizes the importance of analyzing a company's management. Can you explain why that matters so much?
A company's management team is responsible for making strategic decisions, allocating capital, and overseeing the day-to-day operations of the business. The quality of a company's management can have a significant impact on its long-term success or failure.
So it's about looking for signs of competence, integrity, vision, and a commitment to creating long-term value for shareholders.
Exactly. You want to invest in companies that are led by capable, ethical, and shareholder-friendly management teams. Assessing management quality can be subjective and difficult to measure, but there are various sources of information that investors can use to form an opinion.
Such as company filings, annual reports, conference call, transcripts, industry publications, and news articles.
Precisely. It's also essential to consider factors such as the management team's compensation structure, their ownership stake in the company, and their past performance at other companies.
Now, let's zoom out a bit and talk about the importance of understanding the broader context in which a company operates, analyzing a company's industry.
A company's industry significantly shapes its opportunities, its challenges, and its overall risk profile. Analyzing a company's industry involves assessing its growth potential, its competitive landscape, its regulatory environment, and its overall economic sensitivity.
So it's about understanding the forces that are shaping the industry and how those forces might impact the company's future performance.
Exactly. Investors should favor industries with high growth potential, low competitive intensity, favorable regulatory environments, and resilience to economic downturns.
Now, let's talk about a type of investment that can be intriguing but also quite complex, analyzing a company's special situations.
Special situations refer to unique and often temporary events or circumstances that can create investment opportunities. These situations are often driven by corporate events such as mergers and acquisitions, spin-offs, restructurings, bankruptcies, or regulatory changes.
So it's about finding those situations where there's potential for significant price movements or value unlocking due to these special events.
Exactly. Special situations investing often involves analyzing complex scenarios and assessing the potential outcomes of these events. It can be a specialized and potentially lucrative area of investing, but it also comes with its own set of risks and challenges.
It sounds like special situations investing requires a lot of expertise and a high tolerance for risk.
You're absolutely right. Special situations investing often involves in-depth research, financial modeling, legal analysis, and a deep understanding of the specific event or situation. It's not for everyone, but for investors who have the expertise and the risk appetite, it can be a rewarding strategy.
Now, let's shift our focus to a crucial element of investment analysis, understanding a company's financial statements. The material we're diving into emphasizes the importance of scrutinizing the income statement.
The income statement, also known as the profit and loss statement, summarizes a company's revenues and expenses over a specific period, ultimately wrestling its net income or profit. It's essentially a financial snapshot that tells you how much money the company brought in, how much it spent, and how much profit it made.
So it's like a scorecard that shows how well the company's doing in terms of generating profits.
Exactly. By analyzing the income statement, investors can assess a company's revenue growth, its cost structure, its operating margins, and its overall profitability trends. It helps them understand the company's earning power and its ability to generate profits from its core business operations.
Now let's talk about a type of security that combines elements of both debt and equity convertible bonds. The material we're reviewing today delves into their characteristics and their potential appeal to investors.
Convertible bonds are hybrid securities that combine features of both debt and equity. They are essentially bonds that can be converted into a predetermined number of shares of the issuing company's common stock at the option of the bondholder.
So they offer investors a way to participate in the potential upside of the company's stock while still receiving a fixed income stream from the bond.
That's the idea. Convertible bonds can be appealing to investors who are seeking both income and potential capital appreciation. They can also be a way for companies to raise capital at a lower cost than traditional debt, as investors are willing to accept a lower interest rate in exchange for the conversion feature.
Now let's shift our focus to a critical aspect of investment analysis that can be difficult to quantify, but is nonetheless essential analyzing a company's management.
A company's management team plays a critical role in its long-term success. They are responsible for making strategic decisions, allocating capital, and overseeing the day-to-day operations of the business. Analyzing a company's management involves assessing their track record, their experience, their strategic vision, their capital allocation skills, and their alignment with shareholder interests.
So it's about looking for signs of competence, integrity, vision, and a commitment to creating long-term value for shareholders.
Exactly. You want to invest in companies that are led by capable, ethical, and shareholder-friendly management teams. However, assessing management quality can be subjective and challenging to measure.
Right. There's no foolproof formula for evaluating management.
That's true. Investors need to gather information from various sources and form their own judgments. They can look at company filings, annual reports, conference call transcripts, industry publications, and news articles to get a sense of the management team's track record, their decision-making process, and their communication style.
It's also important to consider factors such as their compensation structure, their ownership, stake in the company, and their past the performance at other companies.
Absolutely. These factors can provide insights into their incentives, their alignment with shareholder interests, and their overall capabilities.
Well, it seems like we've covered a lot of ground already. We've explored a range of concepts from security analysis and discussed how they apply in today's market.
It's been a fascinating discussion. We've seen how Graham and Dodd's principles have stood the test of time and how we can adapt their wisdom to navigate the complexities of the modern investment world.
And we're just getting started. There's much more to uncover in these materials, and I'm eager to delve deeper into specific areas that are particularly relevant to you. Now that we've set the stage and explored some key principles from security analysis, let's dive deeper into specific areas that you might find particularly insightful as you refine your investment strategy by integrating both classic wisdom and modern adaptations.
Excellent suggestion. Where would you like to start?
Well, I was particularly struck by Graham and Dodd's emphasis on analyzing a company's income statement. They considered it the most revealing of the financial statements.
Indeed. The income statement, often referred to as the profit and loss statement, details a company's revenues and expenses over a specific period, ultimately revealing its net income or profit. It provides investors with a fundamental understanding of the company's ability to generate earnings from its operations.
So it's like a financial performance snapshot, showing how much money the company brought in, how much it spent, and how much profit it made.
Precisely. By examining the income statement, investors can gain insights into a company's revenue growth trends, its cost structure, and its operating margins, which help assess the company's efficiency and profitability.
But it's not just about looking at a single year's income statement, right?
Yeah. Absolutely not. Value investors like to analyze a company's income statement over several years to identify trends, patterns, and any red flags. For example, consistent revenue growth over time is generally a positive sign, while erratic earnings might warrant further investigation.
That makes sense. It's about looking for consistency and sustainability in a company's earning power.
Exactly. The income statement can also provide insights into a company's cost management. Are its expenses growing faster than its revenues? Are its profit margins shrinking? These are important questions that investors can explore by analyzing the income statement.
The book also highlights the significance of analyzing a company's balance sheet. Can you remind us why that's so important?
The balance sheet is essentially a snapshot of a company's financial position at a specific point in time. Think of it as a financial inventory that shows what the company owns, its assets, what it owes, its liabilities, and the ownership structure equity. It's like peeking into the company's financial health.
So by examining the balance sheet, investors can assess a company's financial health, its liquidity, and its overall financial risk.
Absolutely. It provides insights into a company's capital structure, its asset base, its debt levels, and its overall financial stability. It can reveal whether a company has a strong financial foundation or if there are potential vulnerabilities that need to be addressed.
Now, let's move on to a type of security that combines aspects of both debt and equity. Convertible bonds. The material we're reviewing today delves into their characteristics and their potential appeal to investors.
Convertible bonds are hybrid securities that offer investors a unique combination of features. Essentially, they are bonds that can be converted into a predetermined number of shares of the issuing company's common stock at the option of the bondholder.
So they offer a fixed income stream like a bond, but with the potential for upside if the company's stock price rises.
Exactly. This makes them appealing to investors who are seeking both income and potential capital appreciation. They can also be attractive to companies as a way to raise capital at a lower cost than traditional debt, as investors are willing to accept a lower interest rate in exchange for the conversion feature.
But it's crucial for investors to understand the complexities of convertible bonds, right?
Absolutely. Investors need to carefully consider the terms of the conversion feature, including the conversion price, the conversion ratio, and the conversion period. They also need to assess the company's stock price volatility and the overall market conditions when evaluating convertible bonds.
Now let's shift our focus to a critical aspect of investment analysis that's often considered more art than science, analyzing a company's management.
A company's management team plays a pivotal role in its long-term success or failure. They are the stewards of the business, responsible for setting the strategic direction, allocating capital, and overseeing the day-to-day operations.
So analyzing a company's management involves assessing their track record, their experience, their strategic vision, their capital allocation skills, and their alignment with shareholder interests.
Precisely. It's about looking for signs of competence, integrity, vision, and a genuine commitment to creating long-term value for shareholders. Unfortunately, there's no foolproof formula for evaluating management quality.
Right. It's often a qualitative assessment based on a variety of factors.
Exactly. Investors need to gather information from various sources and form their own judgments. They can look at company filings, annual reports, conference call transcripts, industry publications, and news articles to get a sense of the management team's track record, their decision-making process, and their communication style.
It's also crucial to consider factors such as their compensation structure, their ownership stake in the company, and their past performance at other companies.
Absolutely. These factors can provide valuable insights into their incentives, their alignment with shareholder interests, and their overall capabilities as leaders.
Now, let's zoom out a bit and talk about the importance of understanding the broader context in which a company operates, analyzing its industry.
A company's industry significantly shapes its opportunities, its challenges, and its overall risk profile. It's essential for investors to understand the industry dynamics, the competitive landscape, and the forces that are shaping the industry's future.
So analyzing a company's industry involves assessing its growth potential, its competitive landscape, its regulatory environment, and its overall economic sensitivity.
Exactly. Investors should carefully consider the industry's growth prospects, the level of competition, the regulatory landscape, and the potential impact of economic factors such as interest rates, inflation, and consumer spending on the industry's performance.
Right. A company operating in a high-growth, non-cyclical industry with favorable regulations might be more attractive than a company in a declining, highly competitive and heavily regulated industry.
That's a great point. Investors should favor industries that are experiencing growth, have manageable competition, operate in a supportive regulatory environment, and are relatively resilient to economic downturns.
Now, let's shift gears a bit and discuss a crucial element of investment analysis, understanding a company's cash flow. The material emphasizes the importance of analyzing both cash flow from operations and free cash flow.
Cash flow is the lifeblood of any business. It represents the actual cash that is flowing in and out of the company, and it's a crucial indicator of a company's financial health, its profitability, and its ability to generate value for shareholders.
So cash flow from operations refers to the cash generated from a company's core business activities.
Exactly. It shows how much cash the company is generating from its sales after deducting its operating expenses, such as the cost of goods sold, salaries, and rent.
And free cash flow takes it a step further by subtracting capital expenditures.
Precisely. Free cash flow represents the cash that's left over after a company has covered its operating expenses and its capital expenditures, which are investments in long-term assets like property, plant, and equipment.
So free cash flow is the cash that's available to the company for things like paying dividends, reducing debt, buying back shares, or making acquisitions.
That's right. Analyzing a company's free cash flow can help investors assess its financial flexibility, its ability to generate returns for shareholders, and its potential for future growth.
Now let's talk about a concept that can be particularly useful for value investors analyzing a company's book value.
Book value represents a company's net worth as reported on its balance sheet. It's calculated by subtracting a company's total liabilities from its total assets. Essentially, it represents the theoretical value of a company if it were to be liquidated and all its debts were paid off.
So it's like a baseline valuation that provides investors with a sense of what the company's assets are worth on paper.
That's a good way to think about it. However, it's important to remember that book value doesn't always reflect a company's true intrinsic value.
Right. It's based on historical accounting figures and might not capture the full value of a company's intangible assets, its growth potential, or its brand reputation.
Exactly. Think of a company like Apple. Its brand name, its intellectual property, and its customer loyalty are worth far more than what's reflected on its balance sheet.
So while book value can be a useful starting point for evaluation, it's crucial to consider other factors as well.
Absolutely. Investors need to look beyond the balance sheet and consider factors such as a company's earnings power, its growth prospects, its competitive advantage, and its management quality when assessing its true worth.
Now, let's move on to a topic that has become increasingly important to investors in recent years, analyzing a company's environmental, social, and governance ESG factors.
ESG factors encompass a broad range of non-financial considerations that can have a significant impact on a company's long-term sustainability, its reputation, and its social impact.
So it's about looking beyond just the financial performance of a company and considering its broader impact on the world and its stakeholders.
Precisely. Precisely. Environmental factors include a company's environmental impact, its carbon emissions, its resource management, and its efforts to mitigate climate change. Social factors encompass a company's relationships with its employees, its customers, its suppliers, and the communities in which it operates. Governance factors relate to a company's corporate governance practices, its board structure, its executive compensation, its shareholder rights, and its ethical behavior.
It seems like investors are increasingly recognizing that ESG factors can have a material impact on a company's long-term value creation and its risk profile.
That's right. Companies with strong ESG practices are often seen as more resilient, more responsible, and more likely to generate sustainable returns over time. They might also be better positioned to manage risks related to climate change, social unrest, or regulatory changes.
Now let's delve into a concept that's essential for understanding a company's ability to compete and thrive in the marketplace, analyzing its competitive advantage.
A company's competitive advantage refers to the factors that allow it to outperform its rivals and maintain a sustainable position in the marketplace.
So it's about understanding what makes a company unique, what sets it apart from its competitors, and what allows it to generate superior returns. What are some examples of competitive advantages that companies might have?
Great question. Competitive advantages can take many forms, but some common examples include cost leadership, product differentiation, brand recognition, strong customer relationships, technological innovation, network effects, economies of scale, or access to scarce resources.
Let's break down a few of those. What does cost leadership mean?
Cost leadership means that a company is able to produce its goods and services at a lower cost than its competitors, allowing it to either offer lower prices to customers or maintain higher profit margins.
And product differentiation.
Product differentiation refers to a company's ability to offer products or services that are perceived as unique or superior to those of its competitors. This differentiation can be based on features, quality, design, brand, image, or customer service.
And brand recognition.
Brand recognition is the value that customers attach to a particular brand. Strong brands can command premium prices, attract loyal customers, and resist competitive pressures more effectively.
Now let's talk about analyzing a company's growth potential.
Growth is a key driver of stock price appreciation. So investors are always looking for companies that are demonstrating consistent and sustainable growth.
So analyzing a company's growth potential involves assessing its ability to expand its revenues, earnings, and market share over time. What are some key factors that investors should consider when evaluating a company's growth potential?
Investors typically consider factors such as the company's industry growth rate, its market share, its product innovation, its expansion into new markets, its strategic acquisitions, its management team's capabilities, and its overall business model.
So it's about understanding the company's growth drivers and assessing whether its growth is sustainable and likely to continue in the future.
Exactly. It's also important to distinguish between organic growth, which comes from expanding the company's existing business, and growth through acquisitions, which can be riskier and require careful due diligence.
Now, let's move on to a topic that can be quite complex, often controversial, analyzing a company's accounting policies.
Accounting is often called the language of business, but it can be a complex and sometimes opaque language. It's crucial for investors to understand a company's accounting policies, as those choices can influence its financial statements and its reported earnings.
So it's about looking beyond the numbers and understanding the assumptions, judgments, and accounting methods that are driving those numbers.
Precisely. Investors need to be aware of potential red flags that might indicate aggressive or misleading accounting practices.
What are some examples of red flags that investors should? What are some examples of red flags that investors should watch out for when analyzing a company's accounting policies?
That's a great question. Some common red flags include significant changes in a company's accounting policies from one period to the next, especially if those changes result in a boost to earnings. The use of off-balance sheet financing to hide debt or other liabilities. Aggressive revenue recognition practices, such as booking revenue before it's actually earned. Unusual or complex transactions that are difficult to understand or that seem designed to obscure the company's true financial position, and a high proportion of earnings that come from non-operating activities such as asset sales or investment income rather than from the company's core business operations.
It sounds like investors need to be quite savvy about accounting practices to detect these red flags.
It certainly helps to have a solid understanding of accounting principles and financial statement analysis. But even if you're not an accounting expert, you can still look for warning signs and ask questions. Don't be afraid to dig deeper and seek clarification if something seems unclear or too good to be true.
Now, let's shift our focus to a type of investment that involves analyzing a company's ability to generate cash flow. The material mentions the concept of free cash flow. Can you remind us what that is and why it's important to investors?
Free cash flow represents the cash a company generates from its operations after deducting capital expenditures, which are investments in long-term assets like property, plant, and equipment. It's essentially the cash that's left over after a company has covered its operating expenses and its investments in its future growth.
So it's a measure of the company's financial flexibility and its ability to reward shareholders, reduce debt, or reinvest in its business.
Exactly. Companies with strong and growing free cash flow are generally in a better financial position than companies with weak or declining free cash flow. They have more options for deploying their cash and are less reliant on external financing.
Now, let's discuss an investment strategy that involves seeking out companies that are facing financial distress or that are going through bankruptcy proceedings. The text mentions the concept of distressed debt investing. Can you explain what that is and why it might appeal to certain investors?
Distressed debt investing is a specialized and often high-risk strategy that involves purchasing the debt of companies that are in financial distress or that have filed for bankruptcy. The idea is to buy this debt at a deep discount, hoping that the company will eventually restructure its debt, recover financially, and repay its creditors, allowing the distressed debt investor to profit from the price appreciation of the debt.
So it's a bit like a vulture investor swooping in and buying assets on the cheap, hoping to profit from the turnaround.
That's one way to look at it. Distressed debt investing can be a highly lucrative strategy, but it also requires a deep understanding of bankruptcy law, financial analysis, and the complexities of corporate restructuring. It's not for the faint of heart.
Now let's talk about a type of security that gives investors the right to buy a company's stock at a specific price, stock options.
Stock options are contracts that give the holder the right, but not the obligation to buy or sell a company's stock at a specific price, known as the strike price or exercise price, within a specific time frame. They can be a powerful tool for investors, but they're also complex and can be risky.
So they offer investors a way to potentially profit from movements in the company's stock price, but they can also expire worthless if the stock price doesn't move in the desired direction.
Exactly. Analyzing stock options requires understanding their key characteristics, including their strike price, their expiration date, their intrinsic value, the difference between the stock price and the strike price, their time value, the premium paid for the options, potential to increase in value, and their implied volatility, a measure of the expected price fluctuations of the underlying stock.
It sounds like options trading requires a certain level of sophistication and a willingness to tolerate risk.
It certainly does. It's essential for investors to thoroughly understand the mechanics of options, the factors that influence their value, and the potential risks involved before engaging in options trading.
Now let's step back and revisit the importance of understanding the broader context in which a company operates. Can you remind our listener why analyzing a company's industry is so crucial?
A company's industry significantly shapes its opportunities, its challenges, and its overall risk profile. Analyzing a company's industry involves assessing its growth potential, its competitive landscape, its regulatory environment, and its overall economic sensitivity.
So it's about understanding the forces that are shaping the industry, such as technological advancements, demographic shifts, regulatory changes, or economic trends, and how those forces might impact the company's future performance.
Precisely. Investors should favor industries that are experiencing growth, have manageable competition, operate in a supportive regulatory environment, and are relatively resilient to economic downturns. They should be cautious about investing in industries that are facing decline, intense competition, burdensome regulations, or high sensitivity to economic cycles.
Well, it seems like we've covered an incredible amount of ground in this deep dive into security analysis and the insights from modern investment masters.
It's been a fascinating journey through the world of investment analysis. We've explored a wide range of concepts from fundamental analysis to technical analysis, from financial statement analysis to industry analysis, and from value investing to special situations investing.
We've also discussed the importance of understanding a company's management team, its competitive advantage, its growth potential, its accounting policies, and its ESG practices, among other factors.
The key takeaway is that successful investing requires a holistic approach, combining thorough research, careful analysis, and a disciplined mindset.
Exactly. It's about developing your own investment philosophy, understanding your risk tolerance, and making informed decisions based on a comprehensive assessment of the available information.
Remember, investing is a journey, not a destination.
It's about continuous learning, adapting to changing market conditions,
Yeah.
and always seeking to improve your understanding of the investment landscape.
We hope this deep dive has provided you with valuable insights and a solid foundation for your investment journey.
And remember, we're always here to help you navigate the exciting world of investing. If you have any questions or need further guidance, please don't hesitate to reach out.
Happy investing.